Hi everybody, it's Ted Bauman here with your Friday video comment from me as part of the Bauman Daily series. It's been a wild week in the markets. I'm recording this on Wednesday midday. It looks like the markets are a little bit down today after a furious upswing yesterday that set records. The Dow rose by the largest amount since 1933 yesterday. And the reason for that was the stimulus bill that looked like it was agreed upon late last night or early this morning actually. By the Senate, which will now go to President Trump for signature. So this bill and this stimulus is clearly very important to the economy and what's happening. And today I want to look at how it's going to work, particularly the part that affects the banking system, because I think it's an important thing to understand, because a lot of your tax money is going to go to backstop the financial system, just like in 2008 and 2009. A lot more money is going to be doing that than is going to be handed out to people and small businesses. And I think it's important to understand the rationale. And then you can decide whether you agree with it or not. To understand why this bailout is taking the form of potentially up to a $4 trillion credit facility to Wall Street. That's right, $4 trillion to backstop Wall Street and maybe $2 trillion for the individual and corporate sector. That's what the bill contains, not well understood. Anyway, to understand why that's happening the way it is, let me show you a graphic that illustrates the way traditional banking used to work, the way it was taught in textbooks when I studied economics, but which hardly happens anymore. Now here's the graphic. In this model, you put your money into a bank account and the bank pays you a little bit of interest. You can take your money out anytime, but you and other people leave your money in the bank for extended periods, and the bank uses that money to lend to people to do things like buy houses. Those people who borrow to buy houses pay interest over typically a 30-year term, and the interest that the bank earns, part of it goes to their profit, part of it goes to you as a saver. You get part of what is paid into the system by the borrowers. Now, this system typically works and has worked for centuries because most depositors don't want their money back all the time. Or they basically are willing to leave their money in the banks for extended periods, which allows banks to make large loans over longer periods. Now, the modern banking system, on the other hand, looks like this. Now, in this system, most of the money that ends up going to mortgage lending, for example, comes through money market funds. People who buy shares in money market funds, most of us probably have some of our money in them. But essentially, money market funds are big closed-end funds that invest in all kinds of different instruments and basically try to beat the market, but in a safe way. They pay a little bit of interest, and people who buy shares in money market funds can take them out at any time by selling those shares. Now, the money market funds then lends the money that you and other people put into a big dealer bank, and they do it in the repo market. The repo market is where big institutions make short-term loans to each other in exchange for collateral like treasury bonds or mortgage-backed securities, which are basically bunches of mortgages that have been put together and chopped up and sold to investors in slices. Now, the money market fund can ask the bank to pay back that money at any time. Now, the third step is that the dealer bank lends the money again in the repo market to mortgage real estate investment trusts, or REITs. Now, I've invested in a couple of REITs in the Bauman letter portfolio, and they are essentially a special form of company that focuses on real estate, but some of them do it through mortgages, not through actually owning real estate. So this special group of REITs then gets money from the repo market, from dealer banks, and in turn, they put up collateral in the form of mortgage-backed securities, which the REITs acquire. Now, the dealer banks can take their money back on short notice from these REITs, or they can issue margin calls if the mortgage-backed securities lose value. So this is an important step in the chain. Basically, the real estate investment trusts that specialize in mortgages are the one step in the chain where the banking system can ask for their money back, but it has to be done on notice. Now, mortgage REITs use this money, as I said in the fourth step, to buy mortgage bonds from mortgage lenders, like your local bank. It generally can't get its money back, but it can sell those bonds if it needs to raise money. So if a REIT has bought a bunch of mortgage-backed securities, it can sell those in order to raise money, but it can't just ask for its money back because these are bonds, they're not direct loans. Finally, the lenders, your local bank, gets money from these REITs through mortgage-backed bonds. It makes a loan and immediately sells it into the market as a securitized bond, then uses that money to generate new mortgages, which people then pay interest on over 30 years. So the bottom line here is that, as you can see, this is a far more complex system, and it has a lot more players in it than the normal mortgage market. And the distance, if you like, between you as the person who's putting up the money by investing it in a money market fund and the actual end user who borrows that money is mediated by really 4 steps at 4 different levels. And at each one of those steps, any one of those players can decide at any time that they're not happy with what they're seeing in the market and ask for their money back. Now, when that happens, which is precisely what we saw in 2008 and 9, the whole system collapses. Because basically, if anybody in this cycle starts asking for their money back, those lower down on the food chain are compelled basically to try to raise cash. That means, for example, that REITs need to sell mortgage-backed securities as quickly as they can, which leads to a decline in their price, which in turn leads to an increase in mortgage rates, because it means that the amount of money available for lending is less, because everybody's trying to sell existing mortgages to generate cash. Now, as you can imagine, in circumstances like these, when everybody's trying to put cash together as a buffer, particularly in the banking system, this puts tremendous strain on this type of approach to mortgage financing. And the result is that the market seizes up and you have really a collapse, a potential collapse in important sectors of the economy. And this week we saw a number of mortgage-backed REITs looked like they were close to collapse. They said that they could not meet their margin calls. They would not be able to pay back the dealer banks who had lent them money. Now, this is where the Fed comes in, and this is why the bailout that the government has constructed includes so much money for Wall Street. The idea is that if, for example, a REIT desperately needs to raise cash, but nobody wants to buy their mortgage-backed securities, the Fed will step in with their own facility to buy those securities in order to relieve pressure on the REITs. They can do that to anybody in this chain, with the exception of the people at the end, you as the person who's invested in the money market fund and the person who borrows the money at the end of the day. Everybody else, all the other steps in the chain, the dealer banks, the mortgage REITs, the securities markets, all of them, including money market funds and hedge funds, can go to the Federal Reserve and get liquidity. They can sell some of the assets, which are really debts other people owe to them, in exchange for liquidity. Now, this is a huge part of the stimulus that the government is putting out. Now, here's the problem. It may keep the chain open, but that doesn't mean that the chain is going to keep operating. And this is why we've seen housing stocks and stocks in other residential construction and other kinds of industries related to housing hammered so hard over the last few weeks. You see, the problem is that this whole system depends on the ability of people at the bottom end of the chain, the people who make the mortgages, who loan money for people to buy and build houses. It depends on their ability to assess the value of those houses. Now, if the mortgage system is under strain and people have questions about how many mortgages are going to be available and on what terms, then it becomes very difficult for banks to decide whether a house is actually worth what the borrower is trying to borrow. And as a result, banks tend to make fewer loans. They tend to say, well, we can't be sure that these houses are worth what they were last week or last month or last year, simply because we know that the mortgage system is in turmoil, and right now it's depending on a Band-Aid from the Federal Reserve to keep functioning. So the problem is that even though the Fed is going to step in and provide all of this liquidity at all these stages in the banking system, and the mortgage lending system, it doesn't mean that housing is going to restart, because frankly, a lot of people are losing income. So it all comes back to the question of the other side of the stimulus. Will the stimulus be enough to allow ordinary Americans to continue making their payments on their mortgages? Will people be able to get back to work and earning a living soon? That becomes the most critical issue. And here's where I think there's an imbalance in the stimulus package that the government has passed, that Congress has passed. It allocates most of its money to Wall Street and to big institutions like those at the top of the chain, compared to how much money is going to the bottom of the chain, people like you and I. And the result of that is that despite the fact that these big Wall Street players will have a lot of money on hand to cushion their problems, ordinary Americans won't have as much. I mean, if you think about it, how long is $1,200 going to last most people? Now, so that illustrates that unless there are further stimulus payments basically made into the economy, it's not going to necessarily be the case that the banking system is going to stimulate by pushing out money for people to borrow houses and cars. Because logically they will say, well, we've got money to lend. The Fed has made sure of that. We don't have any problems, but we can't be sure that our customers, our clients, our borrowers will have money. So the result of this is that this lopsided stimulus package, I think, is going to result in some perverse outcomes that we should start thinking about. One of them is that it probably won't stimulate borrowing in big ticket markets like housing and cars, as I've explained. But the second one is I anticipate a big jump in hostile takeovers, in mergers and acquisitions as a result of this amount of money that's now available to Wall Street, but which really has nowhere to lend it in the real economy because people just don't have enough money despite the stimulus. So watch out for companies being taken over by other companies, particularly in sectors like pharmaceuticals and technology, in the internet sector. So I predict we're going to see a lot of action in those particular sectors as this sudden influx of cash into Wall Street as a result of the stimulus gets used to buy assets for wealthy banking and money market funds, hedge funds, etc., etc. You and I, not so much. And I think that we're looking at trouble down the road on this front, because once people realize that we're kind of setting ourselves up for a rerun of the 2008 crisis, where the banks got bailed out, the banks then used that money to invest in asset markets, leading to fantastic wealth creation at the top of the pyramid, but long-term stagnation at the bottom of the pyramid. That could make things very difficult, I think, politically in this country. In terms of opportunities, I think you should look out for ETFs, exchange-traded funds that specialize in the sectors that will see mergers and acquisitions. Again, technology, biotechnology, pharmaceuticals, internet stocks, and things like that. I predict that these are going to recover very quickly from the downturn because other people are going to start doing the analysis that I've just done for you. The money's going to the top, it's going to Wall Street just like it did in 2008 and 9. That means that assets that those kinds of investors with billions of dollars to play with, those kind of assets are going to appreciate. The rest of us, it could take years to get back to where we were before. Now remember, I'm not making a political comment on this. I am just telling you what I see as an economist looking at the numbers. So this is perhaps only the first round of stimulus. I predict that the government will come under increasing pressure to beef up its cash payouts to ordinary Americans in order partly to offset what people begin to realize when they understand that Wall Street again is poised to make hay while the rest of us are struggling to find enough to pay our bills. Anyway, this is Ted Bauman. Remember, there are opportunities here, as I said. Particularly look for the sectors that are going to be bid up by these big financial institutions with these trillions of dollars of low-cost credit facilities that the stimulus bill provides to them. Anyway, I'll talk to you again next week. Have a good weekend. Remember, if you're not already subscribing to my Bauman letter, click on the link on this email and on below on YouTube in the description so that you can see what else we have to offer. We have some very strong investments that are doing well even now, and I'd love it if you were able to participate in them. Take care, and I'll talk to you next week.